Have you ever looked at your credit score and said, these are 3 numbers, but I have no clue what this means for me? I know I've been there, but your credit score is so important for determining what you can afford as a borrower, but also saving you money. Yes, having a good credit score can actually save you cash money. So in this video today, we are going to talk about the credit score and what it all means, particularly the FICO score. So stay tuned. Hello again, my name is Dr. Brittany Halford, and on this channel we talk about all things personal finance to build more joy and more wealth in all of our lives. And today we are dissecting the credit score. I know I would look at my credit score and that it was important for me to have a good credit score, but I didn't know what all of the components meant. So today I'm going to talk you through the 5 components that specifically makes up your FICO score, which is used by 90% of the lenders. And the first component is your payment history. So what does that mean? Basically, your payment history shows how you've paid back money that you've borrowed in the past. And lenders know that your track record of paying back loans in the past is the greatest predictor for your ability to pay back loans in the future. But again, it's not the only predictor. We evolve, we change, we grow, we know. And so I don't want you to hold on to that payment history as if, oh, I've made a late payment in the past and I'm not going to be a good borrower in the future. No, let's change our mindset right now. You can be a good borrower in the future. You just have to make sure that you borrow what you can afford. So let's break this down. Payment history comprises 35% of your credit score, and that is the largest component of your credit score. So it is important that we are paying our bills on time, even if it's just the minimum payments. Which companies are actually included in your payment history? This includes all of your consumer credit cards. So those are the big name companies like MasterCard, Visa, Discover, but also it includes those smaller credit cards, that retail account like Walgreens. Well, does Walgreens even have a credit card? Let's say Walmart instead, Walmart, TJ Maxx, as well as any installment loans. So these are loans like your car loan, mortgage payments, all of those are important as well. And lastly, any finance loan. So if you take out a personal loan to finance something, then that is also included. Additionally, this payment history includes public records and collections. The good news is that the older they are, the least they affect this payment history component. So again, just because you made a late payment in the past does not mean that you are bound to make late payments in the future. We change our behaviors, and so I don't want you to be shackled by your past behaviors when you didn't know any better or when you were in a different situation. So we are going to hold on that we're going to improve our credit by improving our payment history, and I'm going to teach you some things on how you can do just that. But remember that any past collections are also included in this payment history component, and if you have them on your credit report, then they can lower your credit score. So negative factors include any bankruptcies or lawsuits. Typically, these late payments stay on your credit report for about 7 years and bankruptcies about 10 years. Now, when thinking about your payment history, is not just did you make a late payment, but also how frequently are you making late payments. So say, for example, you have a credit card that you've had for 10 months and you've made 10 total payments, and one of those payments was a late payment. Then you still have a good record of having 10 total payments and just one late payment versus 5 of those payments being late. Then that's going to look worse to creditors. You don't want to make any late payments if you can avoid it, but if you are able to make a payment, even if it's within that 30-day period, then you want to make that payment, because credit card companies actually don't report late payments to the credit bureaus until the 60-day mark of your billing cycle or 30 days after that payment is late. So you want to make a minimum payment as soon as possible for any late payments, and you don't want to have late payments across the board on all of your credit cards, because that is going to show that you have a record and a behavior of doing so. As I mentioned, you want to make any late payments as soon as possible, because the duration of time that that payment is delinquent or that account is delinquent is also factored into your payment history. In addition, the amount owed is also factored into your payment history. So you want to pay as much as you can, as soon as you can, and that's going to improve your payment history component overall. And if you have trouble making your payments, then please call your creditors. I mentioned before that you can actually change your payment date. So for example, if you get paid on the 14th of the month, but the payment is actually due on the 12th, call your creditors and ask them if if they can move your payment date to the 17th of the month, and that way you have this extra cushion in order to pay that payment on time. Additionally, one of the things that I do in my life is I like to try to make things simple. I mean, life gets busy. Being a mom, having another baby on the way, being a wife, having this YouTube channel trying to give you guys all of these financial gems, and being a doctor gets really hectic. So sometimes I forget what day it is, and if I have to go in each and every month to make that payment, I'm going to miss a payment. So what I do to make my life easy is I set it up on automatic payment. I am able to pay my credit cards off in full because I budget and I only spend what I budget for. I give myself a little bit of cushion because sometimes I go over a couple of dollars or so, or want to buy some cookies at the grocery store. But I have it set on automatic full payment balance. Now, if you can't pay the full payment, then at least set it out on automatic minimum payment, because it's about making payments consistently. And as you make more payments on time over time, then those late payments are going to affect your payment history less. Now, let's move on to the component of amounts owed. And oftentimes this is talked about in credit utilization ratios. Now, credit utilization ratios basically is the amount of credit that you have available to use and the amount that you actually use. For example, if you have a credit card and you have $100 available to use and you use $80 of the $100 available dollars, then your credit utilization ratio, or credit usage, is 80%. Now, what is factored into this credit utilization ratio is revolving credit. And so revolving credit is credit like credit cards, basically meaning that it revolves. You're supposed to pay it off, and as you pay it off, it renews. Versus an installment credit or installment loans, you have a lump sum and you have a monthly fixed payment. And thinking about your credit utilization ratio or your credit usage, you want to keep that to 30% or less. And if you think about 30%, then this component actually makes up 30% of your credit score. That 30% qualifies for your overall amount of credit usage as well as each credit card. So say, for example, you have 5 credit cards and each of those credit cards have a $100 limit. Then that means the total overall available credit to you is $500. If you on one of the credit cards max it out, then what it's going to show is that you have a credit utilization for that particular card of 100%, although your overall credit utilization is $100 over $500 or 20%. So the goal is to keep your credit utilization to 30% or less for all of your credit cards and also of your overall credit. Say you have a big purchase that you want to make. You have a credit limit of $1,000 and this purchase is actually $1,000. Instead of using one credit card to purchase this $1,000 item, you can use your 3 credit cards to purchase the $1,000 item. And that way you can decrease the credit utilization per each credit card and your overall credit utilization. The goal is to keep them less than 30% for each credit card and less than 30% for all credit cards. You never want to max out one credit card. In addition to credit utilization ratio and thinking about your credit usage, they also take into account the amount owed. That means the amount owed for revolving credit as well as installments. So installment loans are things like car loans, student loans, and personal loans. And how they evaluate installment loans is they look at the amount owed compared to the original amount. So if you take out, again, keeping numbers simple, $100 for student loans, and you have paid back $20, then you still owe $80, and the amount owed for that is 80%. Ideally, you want to get down and pay that debt down as quickly as possible. Installment loans, the remaining balance or the balance owed is not viewed the same way as a credit utilization for your credit card accounts. So if you have to choose between paying down credit card debt and student loan or mortgage debt, then you definitely want to pay down a credit card debt first and decrease the credit utilization of your revolving credit first. That alone will increase your credit score within 2 or 3 months. Next, we're going to talk about the length of your credit history. And just like fine wine, it gets better with time. I feel like I need to have like a glass of wine, but I'm pregnant. Did you guys see my belly bump? 33 weeks. So I think you would judge me if I had a glass of wine to illustrate that point. But when thinking about your credit history, the longer it is, the better it will account for your credit score. For me, I share with you and our first video about credit cards explained that I was able to open a credit card when I was 18 years old. And I've kept that credit card open for the entire duration. If you look at my credit score, my FICO score, the length of credit history actually says 16 years. Now, who can do the math? How old am I? I'm going to let you write that one down in the comments. The credit history accounts for 15% of your credit score. So when you think about your credit history, it's not just the oldest account that you have, but also the newest account that you have and the average of the accounts. Additionally, it looks at how long a specific credit account has been open and how long it's been since the account has been used. You may have heard, oh, if you pay off that credit card, then you should just close that account because you shouldn't have too many credit card accounts open. That is wrong, because remember, it takes into account your longest credit card history and also how those accounts are being used. Are they active or not? If you've paid off a credit card and you don't have an annual fee, what you want to do is you want to keep that account open. Why do you want to keep that account open? Not just because of the length of credit history, but also if you close that account and say that account accounted for 10% of your overall credit limit or available credit, then you would be increasing your credit utilization because you're going to lose that component in the denominator of your credit usage. You're going to lose that available credit. That is why I always advise that you do not close an account unless it has an annual fee that you cannot afford and is not working for you. And before you close that account, then it would be prudent to call your other credit card companies to see if they can increase your credit limits before you close that account. You may say, well, I'm just starting out. I'm just starting to build my credit. How am I going to increase the length of my credit? And one of the ways, which is actually a hack that I did for my younger brother, is I added him on as an authorized user for my oldest account. Now that credit history reflects on his credit report and improves his credit score. Now there are some caveats to doing authorized user. I am a responsible borrower. My credit score is very high and I pay my bills off in full every month. But if you're asking someone to add you as an authorized user, you have to remember that their poor credit behaviors will also reflect on your credit report. If they're paying things late, you don't want that person. It's better for you to just not have that length of credit reflected on your credit report, because remember, late payments actually hurt your credit score more because payment history is 35% of your FICO score. So if you had to choose between having a credit card that has only been open for 10 months versus going to someone and then potentially making a late payment, just don't even ask to be an authorized user. You want to choose the most responsible person who you know pays their bills on time to add you to their account as an authorized user. And oh, there was another point that I wanted to make about this. If you've paid off that credit card and you're not using it, is sometimes the credit card companies can actually close your credit card. An alternative is to set something up that is like a routine payment, like a Netflix subscription on that credit card. Set it to full balance automatic payment. That way that credit card stays active, but it's only a small amount that you're using on that credit card. The next component is your credit mix. And this only accounts for 10% of your credit score. And your credit mix includes basically what type of credit do you have? If you have student loans, then that incorporates into your credit mix and showing that you are a responsible borrower and you can pay your student loans back. Basically, they don't want to see that a person is just using a lot of credit cards. You know, and each time you open a credit card, then that may suggest to the lender that you are unable to afford your cost of living and therefore you need more credit in order to do so. Your credit mix includes your revolving credit. That includes credit cards in addition to any types of loans. If you have a car loan, if you have student loans, if you have mortgage, all of those are included in your credit mix. And remember that this is only 10%. So I don't want you to just go out and get a student loan or get a car loan so you can increase your credit mix. The best thing that you can do is make sure you don't have any late payments and that you use the least amount of credit that you need, keeping overall your credit utilization to less than 30%. And the last component is new credit. And basically it means how new is your credit? Are you applying for credit cards and loans frequently? This can actually help your credit score. Each time you apply for a new credit, then there is a hard inquiry. Hard inquiries is one of the things that can bring your credit score down. However, remembering that new credit is only 10%. So for example, if you get a new credit card that has an additional $5,000 that can add to your available credit and you don't actually use it, you just have this additional money available to use, but you're not using it, then that reduces your credit utilization, which is 30% of your credit score. That can actually increase your credit score. So getting new lines of credit is not always bad, but it's not always good either, because you have to think about your length of credit. And your length of credit with any new credit is going to factor into that length of credit, the average amount for the length of credit. Additionally, if you are someone who's applying for credit cards, maybe you apply for a credit card every month, then that is going to show up as a hard inquiry, hard inquiry, hard inquiry. And it's also going to show
that, maybe this girl cannot actually pay off the money that she's borrowing and can afford her living, and therefore she's opening up these new lines of credit in order to do so.
So that may reflect poorly. With this component, it's always a risk benefit. You're going to risk a little bit by applying for a new credit card. But if you haven't applied for a new credit card, I would say within 6 months, and the new credit card has potential to decrease your credit utilization, then that would be something that would work out in your favor. That's not the only reason to open up a credit card. And whenever you open up a credit card, you want to make sure that it's working for you. So if you haven't watched it already, go back to this video right here where I talk about how to choose the right credit card for you. You may have heard that there's a new FICO score that has been rolled out, and this is called the FICO 10 or the FICO 10T. And basically what this means is that the FICO score will now include more trended data over the past 24 months. What they're hoping is that this will allow lenders to better predict who will default on their loans and who will be delinquent. So in this new model, it is expected that late payments may actually hurt your credit score more than what they did in the past. Also, that personal loans will be taken into account and could affect your FICO score more. But remember, despite it being a FICO 10 or a FICO 9, what we want to do is to make sure that we are making our payments on time and also reducing our credit utilization. So let's focus on the things that we can change and not worry about all the other things that are coming into the mix. But I did want to make you aware of this new score that has been recently released in 2021. Just to recap, because I've said a lot and I know that when thinking about credit scores and all of these numbers, it can get very confusing. So let's review. There are 5 components particularly that are involved in your FICO score. The first component is 35% of your FICO score, and that is your payment history. Number 2 is the amount owed or your credit utilization. So you want to make sure that your credit utilization, specifically for your revolving credit, is less than 30%. Number 3 is your length of credit, and this takes into account your oldest account as well as the average. So any new accounts may decrease this length of credit component. Your next is your credit mix. What types of credit do you actually have? Is it all just credit cards, or do you have a mix of student loans, mortgage, car loans? That is all included in the credit mix. And lastly is new credit. This also accounts for 10%. New credit is one of those tricky things. If getting more credit will increase your overall available credit and decrease your credit utilization, then it may be a wise decision to apply for the credit card. Now, I specifically spoke about your FICO score because your FICO score is used for 90% of the lenders. Remember that there are actually 3 credit bureaus: Equifax, Experian, and TransUnion. And not all credit card companies actually report to all 3. So you may have variation in the credit score depending on which credit bureau you look at. So it's very important that when we look at credit reports that you're pulling your credit reports from all 3 credit bureaus. I want you to subscribe to my channel because we are going to take a look at my credit report and actually break it down and figure out how you can boost your credit. I'm going to give you some very tangible tips of how you can address things on your credit report to boost your credit. So you definitely don't want to miss out on that video. Knowledge is power, and I personally believe that we do better when we know better. When thinking about your credit score, now that you know the components and which components make up the majority of your credit score, you can think about ways in which you can address those issues today so that you can improve your credit score within the next month or 2 months. I hope that this video was helpful. I hope that I broke it down in a way that you can understand. And if I didn't, you have other questions, please leave them in the comments below because I want to help you to help yourself and to help your neighbor. And remember that your past behaviors, your history does not define who you are today and who you are going to be. So I don't want you to feel down if you have a low credit score. I have heard that from so many people that, oh, when I had a high credit score, I felt good because I could walk into a bank and I could get anything. And now that I've made a few mistakes, my credit score is lower and I am limited. But that number alone does not define you. I want you to feel empowered that you can change it, that you can improve it. And I want to help you to do that. Thank you guys for watching this video, and don't forget to subscribe. I will see you next week.